So just like we have two ways of measuring and defining the imbalance, when we do measurements for targeting, there's a low hanging fruit objective, and then there is the extreme. Okay. So I'm going to teach you something in regards to fair value gaps that Chris Laurie never heard about. The guy he learned from never learned about. Everybody out there that does everything else in price action. Okay. Mr. Al Brooks. Okay. You're not going to see him teaching this stuff. Okay. It ain't there. Okay. And I want you to really pay attention to this because this is why my executions are laser precision. But I promise you this what I'm going to show you order flow, level two, footprint, volume profile, GAN, Elliott wave, pitchforks, torches, snares, whatever you want to use. Okay. Trend lines, moving averages, all that business. None of that's going to tell you what I'm going to show you here. Okay. And this is how I look at price action. I look at things in terms of measurements. I look at them in terms of where the algorithm will absolutely interface with the marketplace and the delivery of price. So when we suspend our disbelief whether there's an algorithm or not, okay, I'm going to invite you all to hold that view for a moment. Now, some of you, it's not going to be hard for you to do that because you already believe that. You think it's buying and selling pressure. And while that's cute and very amusing to me, I want you to think about what I'm about to show you, okay? And the degree of statistical probabilities for these things to occur if it was just random buying and selling pressure, okay? If we zoom in, I'll make this a little bit more prominent. Build this up a little bit so we can see the wicks, we can see the bodies, we can see any kind of separations between the bodies. So there's a volume imbalance. If not, all right. So this is the draw on liquidity up here. This is what I told you on the 7th of June. Actually, before that, but on June 7th, that was the last point of analysis. And I broke away from you for a little while and left you to watch the daily chart. And we cleared the minor buy side. We cleared consequent encroachment, which is midpoint, which we'll show you real quick. Just roughing it, not trying to be perfect about it. Okay. So we hit consequent encroachment there or event horizon. So between two pools of liquidity, an old high, split the range in half. We closed above it. Okay. That gives confidence that we're likely to draw to this level. It's not a guarantee. It's not a panacea. It's not a be all end all. It's not an absolute. It just, when I see that type of thing, to me, I feel a little bit more confident that it's going to trade higher. And it did the very next day on Wednesday. So we have this buy sign imbalance, sell sign inefficiency here that formed on Tuesday of this week. Okay. And it's in the direction of the terminus or target I outlined for us to be observing, which is that 101.977 level right here. Because we've had a nice run and we only had one down close candle since the series of that move off of that inversion fair value gap there. This is the only down close candle we had. So it's reasonable for it to slow down or run out of steam, if you will. But just because it could do that, it's not enough. I have to ring in some science and measure some stuff because around here, we believe in a matter of technical science. We don't believe in randomness. We don't believe the markets are random. We're not surprised when markets behave a certain way. And we don't believe in buying selling pressure. So if there is no algorithm, pray tell, how is this going to work? Okay. There are two distinct approaches to how I teach. Okay. I teach an extreme and then I teach the low hanging fruit objective. So in between, that's where the story is going to be the clearest. Now I'm going to show you something here. Okay. And I want to remind you that you do not need this to trade with what I taught and find profitability. You don't need this. Okay. But this is what separates me from everything and everyone else. Okay. So when I taught imbalances and inefficiencies in price, I told you to look at first the wicks. And then we graduated to then looking for when there's a volume imbalance. A volume imbalance is something like this right here. If you look at the close on that candlestick, you see that? It's 100.997. So the open of the next candle needs to be higher than that to be a volume imbalance. So anything above 997, well, look at that. It's over it at 101.005. That's certainly higher than 100, right? So there's a volume imbalance there. So in classic terms, when I first introduced fair value gaps, this is what we were seeing. Okay, you see that? And then eventually, when I felt it was merited, I gave you all a deeper perspective in price action where we include the volume imbalance, where we would discount this short term wick high and go right down to the candlestick's close. See that? And that became the fair value gap. Now, that's two measurements to get a inefficiency defined. But now when we're going to use these inefficiencies, we can now project them into the future and determine very specific price points in an unrealized dealing range. So just like we have two ways of measuring and defining the imbalance, when we do measurements for targeting, there's a low hanging fruit objective, and then there is the extreme. Okay. So I'm going to teach you something in regards to fair value gaps that Chris Laurie never heard about. The guy he learned from never learned about. Everybody out there that does everything else in price action. Okay. Mr. Al Brooks. Okay. You're not going to see him teaching this stuff. Okay. It ain't there. Okay. And I want you to really pay attention to this because this is why my executions are laser precision. This is the reason why these types of things, this isn't all there is. And you don't need this to make money using my concepts. But I'm just doing this to kind of like stimulate your thought process about what it is you're learning here and why you should not fear these markets because they're absolutely rigged. They're 100% rigged. And if there was no evidence to that, what I'm showing you week after week, month after month, year after year, it wouldn't hold up. But yet it does. We're going to make this a little bit bigger. She never said that. So the open of this candlestick starts this price run here. Okay, so it's candlestick number 2 in the fair value gap. So we're seeing the protraction higher, this displacement above these highs here, this run. Resist the temptation to call that an engulfing candle, okay? Because engulfing it doesn't really adequately describe what's going on. It's displacing. It's leaving an area where this candlestick closed. We opened higher. So what did it create? A gap. Opening range gap. Trades lower and it rallies up because it's drawing towards this level up here. This is the draw. This is the big magnet in price action. If I'm going to measure the the influence for the unrealized dealing range, and what is that? The unrealized dealing range is when this candlestick starts and opens higher than this one, it trades down and starts to rally up. Sometime during this day, price was sitting around here. Okay. I'm trying to paint this for you. When price was sitting right here, and we'll say it like this, price was essentially around there. Okay. And this is where on the 7th and before that, earlier in the year, I told you we were going to go towards this level in dollar index. Between this price point or any time during that day, whenever you were looking at it, between that price point and say that was the highest high it had formed for that day so far. So in other words, anything above this line hadn't yet formed. From this point here up to that level, this is what I call an implied dealing range. It's an unrealized dealing range. It means it has not traded there yet. We have an opinion that's going to take us up here, but we have to wait and submit to time. So from here to here, we can start getting an idea where price may reach for. Okay. So this has taken out the previous day's high. So it's an almost guarantee that this is going to be the next run higher. So start where that candlestick opened for the day, right there. Okay. So now from this candlestick's open all the way up to this high, that's an unrealized dealing range. We suspect that price will go there. See, your volume imbalance gives you clues on how to measure certain things. Order flow doesn't determine these types of things. Elliott Wave isn't doing those things. Supply and demand isn't doing that. Okay. Larry Williams isn't doing that. Okay. No disrespect, Mr. Williams. But the point is, this day was Wednesday. It was literally, it was literally part of a sustained price run that got close to our target, but we're on hump day, Wednesday. And we could see a midweek retracement or reversal. And because we hit targets on euro dollar and pound dollar at the same time this was occurring, hello, what up here at this price is significant? Well, let's take a look at the Fibonacci now. This is simply just math, folks. Okay. Math applied to algorithmic principles. If there is an algorithm, and I know we're all supposed to be believing that there isn't one right now, just for the sake of the discussion in the lecture. If I plot that fib from the low of this candlestick body, which is the opening, and drag it on up to the low of this candlestick right there. See what I'm doing? I'm measuring the point at which this displacement begins. It's part of the power three of that day, carried over to the very next day. This candlestick opened here, dropped down a little bit, and then from there, it showed its willingness to want to go higher. So there's discount sensitivity on that low. We started on the power three element here, and I already know some of you you're already churning the channel. You're already saying this is too much, and that's okay. But I promise you, there's charter students right now that are drooling, and trust me, I'm going somewhere. This low from that candlestick's opening price, that right there is consequent encouragement. That's not concerning. That's not the focus. But what we want to do now is add a level right there. What is that? Negative 1.25. What's the 25? We're assuming that this run here at that open to that low, that range projected in the future, 1.25, that takes us right about there. So here we have 101.795 right there. And then that's the low hanging fruit objective on this measurement. Okay. We have to now get the extreme. What is that going to be? Well, we have a volume imbalance. It's lower than there. Okay. So we have to use the point at which the day closed. So the body tells you the story, the wicks do the damage, right? So we're going to go over to that closing price to open up that fib a little bit further up. And there you go. So now we have 101.805. Okay, you see that? Now, watch, folks. In the recording I was showing you last time, while Price was moving around, meandering, and Caleb sitting right next to me, I was explaining to him that this is going to show a strong likelihood of retracing right from this price level. Now, okay. So now if we have a fib anchored to this 80 and a half down to 79 and a half, make sure it's showing on the numbers. Okay. that off. And this right here, we're going to put it as a blue line. Actually, make it a little bit darker like that. I'll extend it out a little bit. It's not too many. All right. So you have a projected portion of price action using my fair value gap, using power three, using the bodies and the wicks to determine a low hanging fruit objective and an extreme projection as well. And between the two, we can measure that out. Now, trust me, I already know what some of you are thinking. How did he figure this out? Right, because if it wasn't him tapping me on the shoulder, say, "Look here," it wouldn't have happened. So all the glory goes to him. So don't call me a genius because it's all coming directly from him. Nobody else out there is teaching this, folks. Because believe me, if they were, I'd be pointing to them saying, "Hey, check this guy out." Okay, but apparently I'm the guy. So here's consequent encroachment of those two levels. Look at the high of that candlestick. As I was telling you in the recording while the analysis was being talked over live, price action, not market replay, not form fitted, not cherry picked. Okay. Right up in here, the high comes in at 101.8. What's the consequent encroachment level? 101.8. Now you're going to tell me, folks. You're going to tell me, okay, Mr. Order Flow, Mr. Level 2, Mr. Volume Profile, Mr. Elliott Wave, Mr. Gann, that all the buyers stopped having an interest in buying there. And then the sellers finally got interested at that price point and sent us down into the close of that day. That's what you're gonna go with. That's what you're going with, right? See, folks, I want you to understand something. Okay, when I show you something, when I'm talking about things, there's scientific data behind it.